Um, don't know. 5%.
Well, that's a pretty close guess. It's more. Let me share the slide. It's more like 6%. And I know you are well informed, you know your numbers, but this 5% is more of a national average. What happens, as you very well know, in Queens, we don't have a lot of land anymore. We have a lot of immigration. We have a lot of people that want to live in Queens, a lot of demand for housing, and we don't have a lot of construction. So the appreciation is 6%. If you compare this to other parts of the country, like Florida or Arizona or California or the Midwest, where you have a lot of land and you have a lot of new construction going on, yeah, the appreciation is going to be a little less because there are availability for builders to build new houses. But we don't have that in New York City. So the appreciation is 6% a year. If we take that into account for the first 7 years of you owning this property, and we are saying first 7 years because the National Association of Realtors is saying that the average time people stay in the first house is 7 years. That's what we're coming with that. If you take into account the appreciation in the first example, in the first and second example, the appreciation is $382,759 that you don't have while you rent. Let me ask you, what can also happen when you rent? What can happen to your rent?
Goes up.
The rent can go up. So we have here two different scenarios. I'm not guaranteeing by any means that your appreciation is going to be 6% every single year, right? And I cannot guarantee that your landlord is going to keep your rent the same. But here we have something else to consider. You are paying rent, most likely if heat goes up, fuel goes up, water goes up, taxes go up, your landlord may have to increase your rent, right? So while you're renting, you don't have the chance to gain the appreciation, right? You do have the chance of your rent going up. So this is a big advantage. If we take this into account, the money that you would be saving by renting and the money that you could get by just owning the property 7 years, in the case of the first example, we are talking about $497,000 in 7 years. In the second example, $415,603 that you are better off owning than renting. So what would you say to people that tell you, don't buy right now, the rates are very high? Let's say you talk to your brother-in-law, let's call him Negative Nate, and he says, oh my God, the rates are too high. The climate is changing. Armageddon is coming. Don't buy right now. What would you say to a person like that?
Negative Nate. He still lives in his mother's basement, right?
I think so. Yeah, because he is afraid of buying.
Exactly. In all seriousness, I've been in the mortgage business 16 years now. And I've never had somebody come to me. I mean, obviously things happen in life where, you know, there's maybe divorces or injuries or unforeseen things that can take place. But I've never had somebody come back to me and say, you know, I regretted buying that house. It's never happened. You know, it's simple math, right? You are going to be wealthier because you own a home. It might take you a little while, right? But it's always going to be better than renting. And aside from the math, which, as you so beautifully laid out, there's the other side of it, which is less stress, right? You own your own home. You are not living on top of other people. You don't have to look 2 hours at night for parking.
Hey, I throw really good barbecues. Don't forget about that.
I was just getting to that. So if you want to throw a barbecue for your kid's birthday or just for your friends for any reason, you don't have to get permission from your landlord. You don't have to worry about what time you have to turn off the music.
You do.
And you have a better...
You have to talk to your neighbors about that.
The way you listen to music, yeah. but you have a better quality of life, which ultimately means you live longer. So not only do you end up with more money, but you have more time to enjoy that money.
Correct. I can agree with that, because this year is going to be 30 years since I started working as a broker. And most of my clients are, you could say, blue-collar people that work hard, that work in the construction industry, transportation, in the food industry. And I can tell you, from when I started, that people bought their first home with whatever down payment they had, with the little down payment they had. And I know in New York it's a little harder because the price of entry is a little higher than in other states. But these clients of mine that bought their first home 30 years ago, that later, 5 or 10 years later, told me, Manny, I want to buy a second home for rental. I am making a little more money down, etc. And now, Joe, they have 2 or 3 homes. One of them is almost paid off, and they are literally millionaires. It's just, we are in a very blessed market in Queens and New York City. The real estate is very strong, it's very stable here. And when there is a crisis in the nation, I'm sorry, there's construction behind me. When there is a crisis in the world or in the nation, everybody comes back to New York City. Did you notice that?
Yep. Absolutely. We've never had a shortage of buyers.
Correct.
Just a shortage of sellers.
Yeah, sure. Like right now, there is no inventory, and a lot of people like to own in New York. That's why if you have the opportunity to save a little bit, like in the case of the FHA, even lower than that, 3%, as Joe said, or even if you have a higher down payment, you should, make an effort to buy. And what happens also is that the rent doesn't go any cheaper in New York. So if you're renting and you think you have an affordable rent, you may be in for a surprise, because time passes very quickly. And after 7 years, 10 years, you have paid a lot of money to your landlord, and that money, you can never get it back, right? Yeah. Let me show you just to prove this argument, that the argument of buying versus renting is also better towards buying in the 2-family scenario. Here we did at the median price of $1,045,000. I changed the rate to 7.5, following your suggestion. And at the end of the day, you could look at these numbers, you could poke holes into that. And I know negative Nate is gonna come and say, no, that's wrong, because my brother is paying taxes of much higher, or utilities could be higher. Look, I'm giving you an average based on my experience and for this house. But if you look at the numbers, if you buy a 2-family house with 20% down, or even with 3.5% down, and you pay mortgage insurance, you are still going to be better off, owning than renting. Here are the numbers. And also, you are going to build equity, right? In those 6 years, you're going to build more equity because this is a more expensive property. So at the end of the 7 years, you could be between over 500,000 better than renting to over 700,000 in this scenario. So this really gives me some rationale of analyzing, are the rates too high? And if the rates become higher, like you're saying, 8 or 8.5, we still have some room where, it still makes sense to buy in Queens, because like you say, it's not only the numbers, it's also the quality of life. It's also the pride of homeownership. It's also having a little bit more financial security. Would you say that?
Yeah, absolutely.
Yeah,
absolutely.
And I know what your brother-in-law Nate is going to tell you. He's going to tell you, oh, what about if the hot water heater breaks? What about if my tenant moves out? What about? Yes, I'm not denying those risks. There are some of that, but don't look only at the risk, right?
Yep.
Okay. Now let me ask you. We're gonna move on to some questions for you. As far as can you briefly talk about what closing costs are? And by the way, in those slides, I included in your investment down payment and closing costs, what the average closing costs are in New York City, and how can you try to lower the rate, what points are, and how do pain points affect your interest rate?
So for condos and 1 to 4 family properties, I would say the average closing costs in New York City are about 3 to 6% of the sales price. The lower the price, the higher that percentage is, because there are still some fees that are the same whether you're buying a property for $300,000 or $1.3 million.
Fixed expenses.
Certain title fees, appraisals vary, but certain title fees, attorney fees, bank fees, survey, things of that nature.
Mm-hmm. Okay, so if I wanted to, I'm a first-time home buyer, and I ask you, look, I hear people say they get quoted a rate with 0 points, or some banks are quoting me a rate with half a point. What are points? What are they for? How can you use them to lower your interest rate? And does it make sense? I mean, and I know this is a very general question, and we could talk, but in a nutshell, if you could summarize.
Yeah, I'll try to simplify it for everyone. So points have a direct correlation with the interest rate that you get. The more points you pay, typically speaking, the lower your rate is going to be. In a normal transaction, where someone is looking to purchase a property to live in and has good credentials, they will usually have the option to pay points or to not pay points. For example, let's say they're taking out a loan of $400,000 and their interest rate is 7.5%, paying the bank 1 point. 1 point is 1% of the loan amount, so $4,000.
In this example, $4,000. 1% of the loan amount is a point, correct?
If they do not want to pay the point, they can choose to take a slightly higher rate, usually about 0.25% higher, so 7.75%. That will increase their payment. However, it would lower their closing costs. And so people should be speaking to their loan officer, and because it's not one size fits all. Some people think points are evil, points are the devil. No, points can be a good tool. It all depends how long you're going to stay in the mortgage and what your plans are for the future.
All right. Okay, so to summarize, 1 point is 1% of the loan, and they are related to the rate in the sense that by paying points, you could lower the rate. Now, you are saying that it would make sense if you keep the house long enough to recoup the money that you pay in the point, and thereon you will start saving. Is that correct?
Typically, it takes about 5 years to recoup that point, not including the tax benefits, because you can write the points off as an expense on your taxes.
Wait, let me react to that. Let me react to that. I have been trying to do this here. You could lower. I'm doing the reaction. You see it? I'm clapping for the I wanted to try this button. Okay, so now I want to get rid of it. Okay, good. So you could deduct the point straight out the first year. I'm sorry.
Correct. Yeah, on a purchase. Yep. On
a purchase. Very good. Another question that I have for you, let's say I'm, again, these first-time home buyers, and I'm thinking about buying a house, and the first thing that I do, instead of getting pre-approved to see how much can I qualify for, is that I start checking interest rates. I Google interest rates every day. What do you have to say to me?